Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
I know somebody who's watching all this very, very closely.
She's got to be busy.
That is Gina Martin-Adam. She's Bloomberg Intelligence Chief Equity Strategist. She's here in our Bloomberg Interactive Broker Studio. Gina, on a day like today, in the context of where we are with earnings season, where do we even begin?
Yeah, good question. You tell me. It's been so busy between the different policy shifts that we've experienced over the last couple of weeks, right in the midst of earnings season, which is a pretty exciting earnings season, frankly. I think big picture, where we begin is what's happening in the aggregate. And what's happening in the aggregate is a pretty significant rotation. And we're all kind of trying to dismiss it as, is it temporary? It's not really lasting. But, small cap 600, as an example, is touching close to new highs at this point in time. We've seen some really strong recovery on the policy put trade, the Powell trade. What's going to happen at the Fed is extremely meaningful for driving stocks returns. And fundamentally, what's happening outside of the Mag 7 is really important to keep your eye on. We have 7% earnings growth for that group. It's the first quarter of earnings growth since 2022. So suddenly we're starting to see some recovery. Financials have been leading that charge. Small cap financials in particular have been surging. We saw a massive beat among the financials companies. So what happens with tech can be very distracting, right? Because tech expectations were the highest. These were the biggest stocks. But what's happening beneath that is very compelling evidence of a pretty big bull market starting to emerge in stocks.
Enough to support the overall indices, though, when those other names are so influential.
Depends on your index, right?
Correct.
The S&P 500, 100% no.
Done.
So the Mag 7 is just too big. These mega cap stocks have driven all the valuation re-rating so far this year, and stocks are up double digits. It's been a great year as far as the S&P 500 is concerned because of that concentrated gain. If those stocks turn over and become more volatile, as I think we're starting to see, it's really difficult for the other 493 to make up for that loss of leadership. Instead, the S&P 500 maybe churns in a sideways fashion. If the Mag 7 do fine, and the rest is catching up, that's an incredible bull market.
So
right? And I think that's actually a possibility given what we've seen in earnings so far.
Well, that's what,
Given
in terms of Mag 7? Or?
Yeah, in terms of the Mag 7. Maybe they're not actually turning over, but they're moving into a period of just no longer being leaders on the market. And that's okay. They don't have to lead for the S&P 500 to move higher. So it is a critical question for the index. Beyond that, non-domestic stocks are breaking out, small caps are breaking out, sort of global equities are suddenly emerging as real possibilities. Japan's been weak, without a doubt. China's still a little dodgy, but Europe's been doing fantastically. Canada's breaking out. So there's some interesting opportunities that are starting to emerge.
Is it a long-term, in your view, trend that we'll start to see diversification away from winners in the S&P 500? I mean, the S&P has beat everybody for the last decade.
Yeah, we should. Over a decade, that's a little outside my pay grade, to be quite honest with you, Tim. I'll just take over the next year or so and go with that. But fair. I do think what we should see is some of the laggards of this cycle start to catch up. And by this cycle, I mean, for me, it was a critical moment in 2022 when the earnings stream for the globe started to turn over. The S&P 500 was at the early stages of that. Small caps joined in the party. Europe is just now getting past its low point, right? The S&P 500, led by the mega caps, led the uptrend in 2023. Now we're starting to see the rest of the world's economies start to participate. And it's difficult to paint it with one big brush, US versus the rest. It's not necessarily, that's not necessarily what's going on, but there are some laggards of that cyclical recovery that are starting to get on board.
Okay.
And I would anticipate that the result of that is some of that just hasn't had any attention. Some of those stocks just have been left for dead. Nobody's even putting any capital to work outside of the U.S. and the Mag 7.
It's amazing.
So
I feel like conversations used to be much more like, oh yeah, you always want to make sure you have something overseas, and it really has been so U.S. focused.
Yeah.
You put out research today, right? That Fed rate cut cycles outside of recessions have historically led to global risk rallies.
Yep.
Outside of recessions, we had a conversation earlier with our Ira Jersey, and he's still thinking that we're going to get some kind of recession.
Well, the earnings stream would tell you that's not happening.
Okay.
So I care most about earnings, and earnings went through a recession in 2022, and they're in a recovery now. Will earnings turn over and hint some kind of recession emerging in 2025? That's a real possibility, but it's not happening right now. And the way that we structure our product is really all about real-time movements, what's happening real-time, not what do we think is going to happen into the future. And so from an equities perspective, I think it's important to acknowledge where we are in the cycle. And where we are is actually improving. We're improving off of lows, for instance, in Europe. Europe had its worst quarter of year-over-year growth just in the first quarter. And it's starting to dig out of that recessionary experience, at least in terms of the stock market, right? That's not necessarily the economy, and I know that there are very big differences on occasion. The U.S. is in very similar position where we're digging our way out of that earnings recession, but really just led by a few names. Now we're starting to see some real earnings growth emerge. Small caps, for instance, by the end of this year, the analyst community is telling us we're going to get small cap revenue growth.
They've been upping numbers?
And they've been moving higher.
Yeah.
So I do think it's important to follow the sequence, and certainly if recessionary signals emerge in the earnings stream, then I have to get a little bit worried. But will we or won't we fall into recession in the economy? I think I've learned my lesson the hard way over the last several years. I can't project what the economy is going to do, and neither can the stock market, so we're going to stick to earnings, and that's what really drives stock prices.
Gina, one thing that keeps coming up in conversations that we have internally when we're planning for our show is a conversation that we had with you back at Bloomberg Invest, where you talked about AI.
Yeah.
And you talked about, I believe I asked you the question about whether or not we're seeing AI gains show up in non-AI specific companies. And you said that hasn't happened yet. Here we are. It's only been 6 weeks since we've had that conversation, but we're hearing from more companies over the last couple of weeks about how AI is helping them. Has your view shifted at all, or are we still not seeing margin improvement thanks to AI?
I think it's early yet in the earnings season. I need to get further through the consumer numbers and the industrials numbers to make really vast conclusions. In financials, which was the one area that we already were detecting companies talking about implementing AI and utilizing AI to drive growth, we are starting to see some real margin improvements, some real cost-cutting measures. So there's a little bit happening in financials.
What's happening? Are they're able to hire fewer analysts? Are they able to get rid of customer service agents because they can use chatbots? What do we know?
Well, so far what we know is it's making them faster.
Okay.
Right? So if anything, it's just making turnover faster. It's not necessarily resulting in job cuts, which I think is everybody's biggest fear, is that the bots are going to replace us all. We haven't necessarily seen that.
I'm scared of that.
But it is making existing workforce faster at what they do. So I would say it's just making profitability improvements and efficiency gains more than anything else. Will that change going forward? We're certainly open to seeing that. I'm most curious to see how it impacts the industrial space and the consumer space, because those are big swaths of the economy that can really make a big difference in the overall economic outlook. And we just haven't seen enough companies come out with reports yet, so we'll see. It is something that we're definitely tracking. I think that from a tech perspective, it's still very much a big part of the conversation. I think you get fits and starts depending upon the company that you're talking to as to whether or not the analyst community maybe got ahead of their skis in anticipating the impact or not. Right. And that's really a company to a company specific conversation, and that's having an impact on stock prices. But net, we're still in the up wave.
Okay.
Well, but in terms of like fundamental analysis, when you look at a company, I feel like you go back a year, and if somebody reported and they didn't talk about AI or talk about how they're planning some of their investing, they got penalized in the trade. Now it's like we're a little bit more, kind of scrutinizing, the CapEx spend and looking for the ROI. Is that smart to be thinking about that? I mean, what I think about companies have to invest for the future, and sometimes it takes a while, but I'm curious how you are looking at that.
Yeah, I think it's too early for AI-specific capital spending to really overwhelm capital spending trends across the entire index. Okay. But it is a really big focus within the tech and communications space. And the tech, I call those tech and tech adjacent companies, where it is very clear that you have to spend and have to now spend smart. A year ago you had to spend, now you have to spend smart in those groups. The rest of the index, I think there's a lot of tolerance for spending on this. CapEx is really just at long-term average share of sales. So we're not looking at an index that is overspent by any stretch of the imagination. And sales are improving incrementally. So as long as cash flow and sales are improving, there's a lot of wiggle room for them to spend a bit more. And frankly, I think that the market loves to see spending in anticipation of future growth prospects. So I think that these companies can announce a lot more spending outside of tech and tech adjacent without having penalties.
Kind of explains the meta story, right? In terms of all the spending, and yet they're bread and butter, helped by AI, but in terms of advertising, even though we can't quite quantify maybe the impact, it certainly shows. I want to go back to the markets, because here we are looking at a day where we are seeing a fair amount of selling. I want to go back to something like the stocks, which up 7% yesterday, down 8% today. Like, that's a wide gap. So I'm trying to understand, definitely a lot more volatility in this market, but I'm not quite sure what it says to me about kind of where we go from here, especially if I hear from you that, hey guys, earnings look pretty good and it's widening out to not just the usual suspects.
Yeah, I think it's a great point, because semiconductors have been our, fearless leader in this market advance for the last year and a half, or however long it's been. Semiconductors has been this very strong, very big breakout sector. And so loss of leadership in semiconductors is always going to be somewhat uncomfortable. And without a doubt, we have lost a lot of that leadership. It is now a very volatile contributor on a day-to-day basis. Investors are getting a little bit nervous, and justifiably so, considering how extremely overbought that sector was. And I think this is the really important point. New investment opportunities are emerging outside of that space. And something we did talk about 6 weeks ago when we were together is we went through an anomalous period of time where AI and AI-affiliated organizations, in particular semiconductors, really drove all of the optimism on the index. It was the only source of growth. And capital naturally concentrated there, so it has been very painful as some of that is unwound and sought new sources of opportunity. But in the longer term, it is a much healthier market if it has more than one leader. And I do think we're moving into a slightly healthier market condition, but that can be kind of painful in the short run. When you had your biggest champion that suddenly kind of takes a back seat, and you have all these new smaller leaders kind of move forward.
Gina, one thing that has changed significantly since we last spoke to you is what the election looks like in November. How is your team watching a change at the top of the ticket, and who could be in the White House come January? I think that there are two issues that are really important to watch, and that is how policy prescriptions play out on trade and how they play out on tax. And what I think is most important to watch in this election is really, no matter who you watch, we have a populist sort of tax structure that could emerge over the course of the next year, no matter who's in office. And this is important to consider, because I think there is a mental construct among most people that invest in stocks that there's one party that's historically been much friendlier to companies in terms of tax, and the other one is less friendly. But in this election, it looks to us like tax rates are generally going to change and go higher, no matter who is at the top of the ticket and who wins in November. And I think that that's incredibly important to watch. Trade is the other issue to watch, but it'll depend upon how policy prescriptions evolve over time.
Any of you who are listening, watching, missed any of it, you got to download our podcast, because that's everything you need to know. Thank you, as always. Gina Martin-Adams, our Bloomberg Intelligence Chief Equity Strategist.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So markets certainly front and center, but also front and center is geopolitical news. And this has to do with Russia freeing Wall Street Journal reporter Evan Gershkovich, as well as jailed Kremlin critics in the largest prisoner exchange with the West in decades in return for a prized assassin sought by President Vladimir Putin. President Biden addressing the exchange, calling it a good day earlier from the White House. He was surrounded by family members of the 4 prisoners who are now coming home to the U.S.
This deal would not have been made possible without our allies. Germany, Poland, Slovenia, Norway, and Turkey, they all stepped up. The deal that made this possible was a feat of diplomacy and friendship. Multiple countries helped get this done. They joined the difficult, complex negotiations at my request, and I personally thank them all again.
That was President Biden earlier today from the White House. With more, we're joined by Dr. Angela Stent, Senior Fellow at Brookings Institution, also the author of Putin's World, Russia Against the West and With the Rest. She's a former National Intelligence Officer for Russia and Eurasia at the National Intelligence Council. Also served in the Office of Policy Planning at the U.S. Department of State. She joins us now from Nantucket. Dr. Stent, always appreciate you taking the time and joining us on Bloomberg Businessweek. Why is this swap happening right now?
So I think, first of all, we have to congratulate the Biden administration, the White House, the State Department, all the people who worked very, very hard and tirelessly to get this done. I think it's happening now because Putin really wanted this assassin from Germany back. I think the message that he's trying to send to his own people when they try and recruit them to join the intelligence services, we have your back and we're not going to let you die in some other prison. We're going to take care of you. So I think it was very important for him to get this particular man back. But also, I think it's partly to show that, hey, you can negotiate with us. We're reasonable. And to sort of make the Ukrainians look as if they're not reasonable, because right now, of course, the Ukrainians are saying they're not going to go negotiate with Russia because there's nothing to negotiate. So I suspect there are a number of reasons for this. And Putin obviously decided not to wait until the U.S. election to do this, but to do this now.
That's what I wondered. Why not wait until the next administration? Is there any, you think, strategizing around that in terms of who might ultimately, we know we're going to get a change. We know it's not going to be President Biden. It's either going to be, we assume at this point, either Donald Trump or Kamala Harris. Do you think any of that played in to his thinking, Angela?
Well, I think when the Kremlin looks at what's happening in the U.S., they see all the polarization and the chaos here, and they're actually not quite sure what's going to happen after November. Don't forget, Germany was a key country in this because Chancellor Scholz had to agree to release an assassin who was in a German prison as part of a U.S. deal, essentially, with Russia, although it was multinational, as President Biden said today in his remarks. But they just weren't sure what was going to happen. And at least they knew that at this point, and apparently Vice President Harris also was negotiating earlier on with Chancellor Scholz, so she was involved in this. So they knew that it could happen with the current people in the administration, but they just weren't sure about what would happen after November. And I think at that point, Putin, he got back a number of spies. The Russians got from the Western countries spies, and what the West got was 16 people who were essentially political prisoners. It was probably viewed to be a better deal for Russia.
Better deal for Russia. So talk to us a little bit about Vadim Krasikov, who was serving a life sentence in Germany for a 2019 killing of a Chechen separatist in a Berlin park. What do we need to know about him?
So what you need to know about him was that, he joined the Russian security services. He was a trained assassin. He had assassinated other people before, and he very methodically planned how he got to Germany. The man he killed was a Georgian citizen, but an ethnic Chechen who was a rebel and who'd been involved in fighting the Russian government. And so he was sent to assassinate him. He had, of course, a false passport. He traveled to Germany via various other countries and posed as a tourist. And he shot the man in broad daylight in the Tiergarten, one of the main parks in Berlin. He was apprehended shortly thereafter. For years, he wouldn't tell them who he really was. It took the German police, obviously, in conjunction with other services, trying to figure out who the man was. And he was in prison in Germany, having been convicted of this. So he is a trained assassin. And from everything we know, Putin really wanted him back. He was the number one person that Russia wanted back.
So if this is maybe a show of faith on the part of Russia and Russian President Vladimir Putin, Angela, is it also showing that he might be open to some kind of negotiation to end this war?
It's possible, but, if you listen to what National Security Advisor Jake Sullivan said earlier today, there really is no connection between this prisoner swap, which was meticulously worked out over months, and which is a kind of a finite negotiation, and the much broader question of how would you begin negotiations to have a ceasefire or to see an end to the war with Ukraine. And we do know that what Putin would like to do is to sit down with the US president if there are going to be negotiations. And President Biden was also asked that briefly today. That's not going to happen with this administration. We don't know about what would happen after January.
Dr. Stent, if Americans who travel to Russia understand that they could be arrested and held and indeed convicted for things that they have no connection to or did not do, what are the implications of that for a relationship that is certainly already strained? I mean, I think about the freedom of the press and the lack of reporting that we see from Russia. Very few news organizations have a lot of journalists in Russia currently.
So it's very dangerous to be a Western journalist in Russia now, and I think most Western journalists have left. There are a few Americans there. I think going forward, and the State Department has already warned people for months, Americans, think twice about going to Russia, because we do know that this is a modus operandi that Putin has. Some of the people who were released today were arrested before the full-scale invasion of Ukraine, almost because Putin was planning this to take hostages. So Russia does this. It's not the only country. Iran, there are a number of other countries clearly that do this, but is to arrest people and hold them hostages. So I think the message is, whatever the negotiation was that produced this success today, it's still very dangerous for an American to travel to Russia without knowing exactly, what they should be doing and without really keeping their mouths shut.
So no doubt about it, in your view, I mean, U.S. officials have accused Moscow of basically, taking American hostages to basically release or win the release of their own Russian agents and others. Moscow says that's not the case. But do you believe that is their mode, as you just kind of said?
Oh, I think it is. I think if you look at the Americans who were released, 3 with U.S. citizenship and 1, Vladimir Karamurza, who has a green card. These are not spies. These were people who were legitimately in Russia doing other things. In Karamurza's case, he certainly criticized the government. The other 3 Americans were there either doing reporting or in Paul Whelan's case, I guess, on vacation. And the Russians who were released today are all political opposition people. And then the German nationals and 1 man from Belarus who were released, none of these people are remotely spies. So this is clearly a political hostage taking. Whereas, of course, the people who were released to Russia, most of them were spies and criminals.
So how does that make you nervous that the people that were released back to Russia are spies and criminals? And how does it kind of factor into your thinking about Russian President Vladimir Putin's ambitions? Still, his ambitions.
They're back in Russia now, and they're not going to leave Russia, or certainly they're not going to come to the West anytime soon. So I think Putin, the Russians we know have heightened their espionage activities in Europe, in the United States for some years now already. And so I think it doesn't really change the view of Russia as seeing the West as its enemy, of believing it can win in Ukraine, that it can outlast the US and the European countries. I think what it means is there were practical reasons for Putin to engage in this exchange that we've talked about, but that not much is going to change in the near future.
Right.
Dr. Stent, 30 seconds left on what happens in November when there is a change at the White House come January 20th. How does that impact relations between Russia and the U.S., if it's Harris, if it's Trump?
Well, I think if it's Harris, there's going to be continuity. We know the people who've been working for her in this administration, the vice president's office, so I think there would be continuity. If it's Donald Trump, we don't know. He has said a number of things. He said that he's going to end the war in 48 hours and a number of other things, but we really don't have any sense of what he would actually do. So I think that's a big unknown. And I think, again, coming back to what we discussed before, this is probably why this exchange has taken place now.
All right. So appreciate it. Everything just explained so clearly. Angela Stent, thank you so much. Really appreciate it. Senior fellow over at the Brookings Institution, joining us from Washington, D.C.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Yeah, as the big tech earnings parade continues, shares of Meta Platforms off and running at its high, up 11%, up right now by 4.4%, the most in 6 months earlier. The nearly $1.3 trillion market cap mega cap reported better than expected sales in the second quarter, the fourth quarter in a row of more than 20% growth. It also gave an upbeat sales forecast after the close yesterday, signaling, Carol, that the company's investments in AI are helping it sell more targeted ads.
Yeah, their CapEx spend too, by the way, also moved up. With a roundup of the quarter and the AI trade that investors are obsessed about but increasingly scrutinizing. Back with us is Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh right here in studio. Great to have you here. So is the rally, which at its high was up about 11%, we saw it in the aftermarket. We were trying to understand because we're like the CapEx spend is up, but what they are showing in terms of what they're making on ads, that delivered, and is that why investors are happy?
I think a couple of things to call out here. One is Meta is uniquely positioned now with their large language model. And, it's hard to put it in numbers in terms of how much really that drove the growth in the quarter. But when you hear their earnings call, it wasn't about Metaverse. Metaverse is like not even in the reference once.
It's amazing.
It was all AI. And the fact that they have their own large language model and they are able to apply it to their family of apps, whether it's the Blue app, Instagram, WhatsApp, that was called, big adoption in the US here, and how they see that monetization. I mean, that was, to me, the standout thing. And that was a complete shift from 12 months back when they were just so upbeat on Metaverse. So clearly changing narrative. And look, you may say Reality Labs still lost $4.5 billion, right. But a lot of those investments are going towards integrating AI within their Ray-Ban glasses. So they are looking at the AI opportunity everywhere they are operating because of their own large language model.
Go ahead, Carol.
Well, but if advertising revenue had disappointed, still their bread and butter, we'd be having a different conversation.
Absolutely. But That's the thing about AI. It's all about data and compute. And Meta has a lot of that because of their scale. So That's why they're doing so well with that ad revenue, because they're applying that in their products, in their ad stack. I mean, they called out how their ad campaign management has become so much easier with generative AI tools, and advertisers are finding a lot of ROI in that.
It's very clear that the company has done a very good job pivoting to AI. But my question for you, Mandeep, is, was it a strategic mistake to rename this company Meta Platforms and publicly say we're going all in on the metaverse, when it seems like they've made, at least internally, a real pivot to AI? And look, I know they're related, but we're not doing this in the metaverse yet.
I think the name change is all gone now. I mean, clearly they got a lot of slack for, the metaverse spend and the shift for a while. And look, we're still going through those easy comps. Second half, the comps get much tougher. So it'll be hard to sustain that 20% plus top line growth. But it was music to everyone's ears, the fact that, they are just, they've moved on from the metaverse, it seems.
It really does seem like that. Yeah. One thing that they did call out, one thing that Mark Zuckerberg called out right at the beginning of the press release, was these Ray-Ban glasses that you alluded to. How big of a product is that? How do you think about that product at Bloomberg Intelligence?
I mean, look, Meta's strategy is very clear. They want to have vertical integration where they own the hardware and the operating system, and then deploy their AI on top of that. What they don't like is deploying their AI on Apple's iPhone or on Android. They want to own everything, which is why, Mark Zuckerberg had this big pivot towards AR, VR. And with AR, they find that opening that even though the addressable market will not be as big as the smartphones and PCs, but it'll still be a good chunk of people who may want, like a glass-based voice assistant. And that could have a lot of use cases. It may not serve as a full-fledged phone, but it could still be pretty handy in terms of driving productivity.
Another platform to read all those ads that are going to come at you through AI. Having said that, when I think about, we kind of keep having these conversations, Mandeep, about Gen AI and large language models and the application, the productivity. Is it easy, the application, in terms of ads? Is that why they're having such a big payoff? Like, is that an easy application? Do you know what I'm saying?
Well, so
we're trying to figure out how Gen AI impacts our world, right? It makes us more productive, how it pays off in terms of financial returns.
Yeah,
is this the easy route?
The best way to contrast it is with Microsoft. They are making a big bet on AI, and they are monetizing it through their, the ad stack, the cloud infrastructure,
right,
and also the co-pilots. So everyone is looking for what are the big applications of generative AI, co-pilots, and the other one is chatbot. Chatbot is where Meta has a lot of room because one, they have engagement. People spend maybe 2 hours across their family of apps.
If you're Matt Miller, maybe 8 hours, but anyway.
So that's where if you deploy AI capabilities and then they have the most sophisticated ad stack, it becomes such a huge revenue opportunity.
Just 20 seconds. What are the questions that people are asking of these virtual assistants in Meta's family of apps that it's able to answer?
Well, all sorts of things that you are looking at, let's say a marketplace or groups where people already had a conversation. The chatbot has become so sophisticated that it can answer any basic question that people may have on a Facebook group or any sort of interaction you have had on WhatsApp Messenger. The chatbot can understand that.
Really cool stuff. Meta up 4% today. It's up almost 40% here in 2024. Mandeep Singh, always amazing.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, it's an interesting day. Warning, maybe not. I don't know. Stocks getting hit. Bonds are rallying. Treasury 10-year, we talked about breaking below 4%. Swap traders now fully pricing in 3 rate reductions this year. Those days of 5-6% on the 10-year seem a long time ago. I feel like it's like a Star Wars movie, a long time ago.
In a galaxy far away?
Yes, exactly.
Well, we've got a perfect guest to talk about what is going on with the 10-year and what she thinks it's going to do over the next few months and maybe even year. We got Katy Kaminski with us. She's Chief Research Strategist and Portfolio Manager at AlphaSimplex. She joins us from Boston, Massachusetts. A favorite guest when it comes to the Treasury trade, no doubt. A good day to have you on with the 10-year falling below 4% for the first time since this winter. What do you make of what's going on in the Treasury market today?
Well, the thing is, things have changed. We've seen signals go from short to long in fixed income, and I think we're going to continue to see that. The biggest change, I'm starting to feel like today reminds me a lot of June, where people are starting to get concerned about demand destruction, and that is just a very different market than a strong economy with higher rates. It's really more about weakness, and is this really weak demand? And I think that means a stronger bond market.
Well, go back to, you said signals have gone from short to long. Explain that.
So in the trend following space, we are looking at where the direction is moving in different markets. And for almost the last 3 years, it's been mostly short signals in fixed income. And now we're actually seeing net flattening out and also long positioning in fixed income, which is the suggestion that sort of tides have turned and that these markets are actually starting to shift back to a more of a long positioning with cuts potentially on the way in the short term. So I think that's really a big change from the last 3 years.
Where did the change come from? Was it thank you, Jay Powell, yesterday saying September, like we're finally getting to it? Is it weak economic data? I mean, we've been having conversations internally, our Bill Maloney that we were just in here, like that this market trade doesn't completely make sense. So I'm just curious, what is it specifically that has said, okay, things are differently, guys?
Well, I think there was some interesting weaker economic data this week.
Right.
The challenge has always been that it's mixed, right? And so I think people are a little nervous because obviously valuations are very high. And as other central bankers have already started to cut rates, like the Bank of England today, and you start to see that there's a lot more pressure on the Fed. So it's really both the Fed and also just general risk-off concern about the fact that the weak economic data is starting to show up, which means that bonds are likely going to rally and stocks may have to sort of retract a little bit. That's how I would say it.
Any of this, Katy, about the U.S. presidential race and the outcome come November?
I think definitely that's part of the uncertainty. We're seeing sort of most people are a little ambivalent about how to think about risk going into the second half of the year and what potential outcomes might be. They seem to be very broad. There's just really not a clear path. The only things that are sort of certain are that we're probably going to see cuts. So that would explain the 10 years breaking that 4% bound. But in general, I think uncertainty is never very good for equities, and we're seeing a lot of it right now.
Hey, Katy, the Fed, is it behind the ball? Did it drop the ball, not cutting?
Well, I would say that, the Fed had been looking at very different data than some of the other central banks. So I'm not surprised given how they've been a little bit more cautious. But as we start to see data that is confirming weaker economic data, they're going to have to react more. And I think that's where, they could get behind the ball in the sense if that data continues to come in negative, it's just going to be more certain that we do have cuts later this year. But of course, our data has been very different from some of those economies that cut a little bit earlier.
How low can we go on the 10%? I mean, on the 10%. How long can we go?
You and I'm mixing metaphors.
Tim and I were just saying, what is wrong with our brains today?
I'm like, am I drop the curve behind the ball? Like,
I can't say activism.
Yeah, Activision. As a company.
Yeah, no.
Yeah,
activism.
we're just. It's August.
Yeah, it should be Friday, but it ain't, as they say. So how low can we go on the 10-year in your view?
Well, it's really going to depend what happens to economic weakness and the data that comes out. I wouldn't be surprised, especially if we have a serious retraction in equities, that you're going to see yields go down a lot more, because that risk-off trade would definitely be visible if we do see sort of a strong reversal in equity markets. So I'd say that, even though the market is expecting 3 cuts, you might still see yields dropping quite a bit more if people get nervous.
What's quite a bit more? We at Bloomberg love those numbers. We love forecasts.
I know you love numbers. I think that's hard to say. I mean, if you look at where we've come, we've gone about 1% from the peak.
Yeah.
So we could potentially see another couple of percent. So maybe we could get back into the 3 range. This year, I'm not thinking extremely low. I think it's going to take time. But, you could definitely see pretty big moves in bonds if it's a sort of reversal, retraction in the equities that is really indicative of a risk-off move where people are actually seeing repricing.
So 3% if we see that reversal or retraction. Ish.
Yes, likely. Yeah.
Okay.
All right. We'll hold you to it, Katy. We always do when you come back.
Bring out the digital recording.
Well, how should we think about the curve or the new normal of the curve in this post-COVID environment?
It's tricky because, really when you think about the curve, it has to do a lot as well with future expectations and also relative yield valuations between different currencies as well. And I think for now, we've seen a lot of inversion and flattening. Maybe we'll eventually see a steepening at some point. I know that that's what everybody was expecting at the beginning of the year, but we'll have to wait and see. I think right now we've seen long-term yields being more bullish than short-term yields. So that may indicate that the longer-term expectations for the long end of the curve are lower yields, but it's still very uncertain how long it's going to take for the short end of the curve and how much time that's going to take.
Katy, in a year where we have geopolitical, we have a U.S. presidential race, we have earnings, we have AI, we have, go through all the things that are out there, trying to make sense of Fed policy or global monetary policy. 30 seconds left here. What is the thing that you think investors just should always keep an eye on to really get an idea of kind of where we go on the fixed income side of things?
Well, I think what is important now is once the tide has turned, now you're seeing that fixed income is definitely, there's signals that we're going to see lower rates. And so if that's the case, oftentimes people don't move quickly enough. So really be aware that you're going to have a big repricing if yields come down, and that's something to take advantage of.
When it moves, right, exactly. Katy Kaminski, thank you so much. Chief Research Strategist, Portfolio Manager over at AlphaSimplex.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.